Hey everyone, and welcome. So, a lot of us probably have ETFs in our portfolios, right? I mean, they're the simple, diversified bedrock of modern investing. But what happens when simple just doesn't cut it anymore? You see, the world of ETFs has gotten a lot more interesting. It's moved way beyond just tracking the market. Today, we're going to break down two of the biggest evolutions out there: Smart Beta, which is all about investing smarter, and Thematic, which is all about investing in the future. We're going to dive into how they work, why they're so different, and how you can think about them for your own goals.
Okay, here's the game plan for today. First, we're going to go back to basics, just for a minute, to look at the classic ETF and really understand its DNA. Then, we'll get into Smart Beta, and this whole idea of building a portfolio around proven factors. After that, we'll pivot to thematic investing. This is where we get to bet on those big, world-changing ideas. Then, we'll put them head-to-head, see how they fit into a real portfolio, and wrap it all up with a super important checklist to guide your thinking. So, let's get started.
All right, let's kick things off with Section 1, ETFs, Beyond the Basics. Look, before we can really appreciate these new strategies, we have to be totally solid on the original concept that, let's be honest, completely revolutionized investing for millions of people. This is all about starting with what you know.
So your classic ETF, it's really a beautiful thing, super simple. It's a fund that holds a whole bunch of stocks, sometimes hundreds, even thousands, but you can buy and sell it just as easily as one single share of a company. And the classic formula, the one used by funds tracking something like the S&P 500, is all based on what's called market capitalization. Simply put, the bigger a company is, the bigger its slice of the pie in the fund. That's it. It's totally passive. No manager is making calls, it's automatic, you can see what's in it, and it's incredibly cheap, which is exactly why it became the foundation of investing for so many of us.
And wow, has that simple idea taken off? The US ETF market is now worth over $9 trillion. Let that sink in. That is a gigantic number. It's bigger than the entire economies of Japan and Germany combined. So yeah, ETFs have gone from this kind of niche thing for finance pros to the absolute default way millions of people build wealth. And it all comes down to getting instant diversification for a tiny fraction of the cost of those old school mutual funds.
But there's a catch to this whole biggest is best method. It has a built-in weakness. As a few companies get unbelievably huge, they start to completely dominate the index. We've seen times where just a handful of tech giants made up almost a third of the entire S&P 500, and that creates a real risk. It means your diversified fund can suddenly swing up or down like crazy based on the fortunes of just a few companies. Your broad market bet suddenly starts to feel like a very narrow, concentrated bet on big tech.
And that right there, that's the big question that changes everything. What if the biggest companies aren't actually the best investments? What if they're kind of overvalued? And what if the real opportunities are with companies that are, cheaper or financially healthier or just have more momentum behind them? This single question, this challenge to the size is everything model, is exactly what opened the door for the much smarter strategies we're about to get into.
And that question leads us straight into our next section, Section 2, Smart Beta. If traditional investing is all about buying the market, Smart Beta is a totally new playbook. It says that how you pick and weight your stocks can be just as important as what stocks you own. It's a move away from just passively owning everything to a much more deliberate, rules-based strategy.
Okay, so what in the world is a Smart Beta ETF? Well, think of it like a hybrid. It's somewhere between passive and active investing. It throws out that simple rule of just buying the biggest companies. Instead, it uses a preset, computer-driven system to pick stocks based on very specific, historically proven traits called factors. I love the basketball analogy for this. A traditional fund is like a coach who only drafts the tallest players. That's it. A Smart Beta fund is like a modern data nerd coach. They might build a team of the best three-point shooters. That's a momentum factor. Or maybe the most efficient defenders, which is like a quality factor. Or they'll find those undervalued players nobody else wants. That's a value factor. The whole point is to build a team with a specific strategic edge that's designed to win.
So let's look at the actual skills or, the factors these funds are bent on. Value is the classic Warren Buffett play. Buy good companies when they're on sale, believing the market will eventually catch on. Momentum is pretty much the opposite. It's about riding the hot hand, buying stocks that have been going up because winners tend to keep winning. Quality is all about financial strength. It looks for companies with low debt and stable profits. Low volatility is for those of us who hate roller coasters. It picks stocks that historically have had a much smoother ride. And size is based on the idea that small cap companies have way more room to grow than the giants and have historically delivered higher returns over time. Each one is a totally different way of trying to get an edge. So, you might be asking, what's the good, the bad, and the ugly here? Well, the main appeal is pretty clear. The potential to get better returns or lower your risk, all based on transparent, data-backed rules. It's trying to get the best of active management without the crazy high fees. But, and this is a big but, the downsides are real. There is no single best factor, and they can go in and out of style for years at a time. Value stocks, for example, got crushed by growth stocks for a long time, so you need a ton of patience to stick with it. Plus, they do cost more than your basic index fund, and you absolutely have to do your homework to understand what you're buying. All right, let's hit pause on that and totally shift gears. Welcome to Section 3, Thematic ETFs. Now, if Smart Beta is a data-driven strategy focused on how to invest, thematic investing is all about the story. It's focused on what to invest in. We're not talking about financial metrics anymore. We're talking about identifying huge, long-term trends that are going to change the world. It's about investing in a narrative. So a thematic ETF at its core is all about betting on a megatrend, a powerful, fundamental shift in how we all live and work. Think about things like the rise of artificial intelligence, or the massive transition to clean energy, or the future of medicine with genomics. The fund manager picks a big, compelling story about the future and then builds a basket of companies that they think will win because of it, no matter what industry they're technically in. It's a high-conviction bet that a specific story about tomorrow is going to play out in a big way. And this robotics and AI example is just perfect for showing you what I mean. A traditional tech fund might just hold a bunch of software and chip companies, but a thematic fund thinks way bigger. It looks for any company that benefits from this AI revolution. That could be an old-school industrial company using robots on its assembly line, a healthcare company making robotic surgery tools, the AI software guys writing the code, and of course, the companies designing the superpowered chips that make it all possible. It completely breaks down those old industry silos to give you this super concentrated exposure to one powerful idea.
I mean, you can see the appeal, right? It's exciting stuff. It lets you invest directly in the future that you believe in, trying to capture that explosive growth from these new technologies. But the risks are just as big. These are highly concentrated, often very speculative bets. Their performance can be incredibly volatile, and their biggest strength, that amazing story, is also their biggest weakness. Great stories attract a ton of attention, and that creates hype and bubbles. The real danger is that by the time a theme is popular enough to get its own ETF, a lot of the easy money has already been made, and you might be buying in right at the peak.
Okay, so we've got these two totally different ways of thinking on the table. One is based on numbers and history, the other is based on stories and the future. So in Section 4, let's put them side by side. Understanding how they differ is absolutely key to knowing how they might fit in your portfolio, or if they should at all.
This chart right here just lays it all out, plain and simple. Let's walk through it. The philosophy is the big one. Smart Beta is a how strategy. It's trying to improve the process. Thematic is a what strategy. It's trying to pick the winners of the future. Their goals follow from that. Smart Beta is trying to fine-tune your returns, maybe smooth out the ride. Thematic is swinging for the fences, trying to hit a home run. And look at how they're built. One is all computer screens and rules. The other is about managers picking stocks based on a big idea. But for you, the investor, the most important lines are at the bottom: risk and cost. Smart Beta is usually a moderate risk, while thematic is high to very high risk. And you definitely pay for that exciting story. Thematic ETFs can easily cost double or triple what a Smart Beta fund costs.
Okay, so now that we get what these things are, the million-dollar question is, how do you actually use them? So in Section 5, we're going to move from just talking about them to putting it all together in a real strategy.
Well, one of the smartest ways to think about this is what's called the core satellite approach. It's a framework that really lets you have the best of both worlds. The core of your portfolio, and we're talking the vast majority, like 70, 80, even 90% of your money, stays in those boring, low-cost global index funds. That's your foundation. That's what drives your steady, long-term growth. Then you use these smaller, targeted satellite positions to make your specific bets. This is where you might add a Smart Beta fund or take a shot on a thematic idea you believe in. This structure keeps your main portfolio safe and sound, while giving you room to play without risking the whole farm.
And this little chart here shows you exactly what that can look like in practice. See that big purple area? That's your 80% core. Boring, reliable, essential. Then you've got your satellites. That 10% in blue could be a Smart Beta ETF, maybe a low volatility fund to try and make the ride a little smoother. And that 10% in green, that's your fund money, your thematic bet on, say, genomics. The key takeaway here is the proportion. These specialized ETFs are the spice. They're not the main course. All right, we're in the home stretch now, and this is probably the most important part. Because knowing about this stuff is one thing, but actually putting your money into it requires some serious homework. So, in our final section, we're going through a non-negotiable investor checklist. These are the 5 questions you have to answer before you ever click buy.
Think of this checklist as your personal rulebook. Step 1, understand the methodology. You have to read the prospectus and know the rules of the game. How does that Smart Beta fund define value? How does that thematic fund pick its AI stocks? If you don't get the process, you're just guessing. Step 2, check the holdings. Seriously, look under the hood. Some of these funds get super concentrated in just 1 or 2 hot stocks. If one company makes up 30% of the fund, that's not a theme, that's a gamble on one stock. Step 3, compare the costs. Fees matter a lot. Is that high fee on a thematic fund really worth it, or are they just charging you for the hype? Step 4, assess the risk, and be honest with yourself. Can you really stomach watching one of these funds drop by 50% without freaking out and selling at the bottom? If not, it's not for you, no matter how cool the story sounds. And finally, step 5, look past the hype. Is this trend real and backed by data with a clear path to making money, or is it just a cool idea that's years away from being a real business? You have to separate the exciting story from the investable reality.
And that really brings us to the main takeaway here. Both Smart Beta and Thematic ETFs are amazing tools. They give regular investors like us access to strategies that used to be only for the big hedge funds. But they are not a magic wand. Smart Beta demands that you trust the data even when it's not working for a while. Thematic investing demands that you not only pick the right future trend, but also avoid paying way too much for it. At the end of the day, whether you're a numbers person or a story person, the things that make you a successful investor never change. In the world of ETFs, clarity on what you're doing, discipline in how you do it, and the patience to let it work will beat hype every single time. Thanks for joining us.